Okay, we are all good to go. We'll go ahead and make you the host. You are good to go.
Okay. Let's see. Can everyone see my screen?
Yep.
Yes.
Hey. Awesome. Okay, so hello everybody. My name is Blanca Sepulveda. I'm an independent financial coach and I go all over the Chicagoland area. It used to be in person, right? But now it's on Zoom. And I just deliver financial education to whoever opens the door. So thank you for the invitation. Thank you for having me come and share some golden nuggets. So my background is banking. I worked at the Federal Reserve Bank of Chicago. I was there 20 years. And when I started learning about finances, I thought, wow, this is something that I never really, I didn't even know myself. And I went to college and I realized that we're not really learning a lot of these things when it comes to money and saving and debt and budgeting and, taxes, you name it. So I started wanting to learn more. I got licensed with the state and I just continued to, to learn and learn so I could share this with other people. So that's why now I dedicate myself to financial education and just, spending, 30, 40 minutes with individuals or groups, letting them know what's available, what's out there so we could, continue living, so we could have a financially independent life. Okay, so everybody ready to get started?
Yes.
Yes.
Yep.
It's going to be very basic. It's not going to be like going over your head too much, hopefully, but I'll make it as simple as possible. And we got to make it fun. All righty. So let's get started. So let's first start with some statistics. When it comes to financial education, we are really, behind. We would, want to be at 100% as close as that to that percentage as possible. But unfortunately, in the United States, we're between 51 and 60% when it comes to financial literacy. And then when we narrow it down a little bit further, in the United States compared to other countries, we're at 57%. So we want to, raise that to be higher, in the 90s and 100%. So again, this is my mission to help as many families as possible to, to make better money decisions. Here are some minority groups, some, differences as well, in percentages. Again, we're not at the mark we want to be. We want to be above average. And so we really need to do a lot of work trying to educate and inform. Hopefully one day they'll have it in the curriculum in schools, especially in high school where it's much needed. I would love to see Money 101 class put into the curriculum so we could all learn, because here are the staggering statistics. Okay, so as you can see here, 58% of Americans have less than $1,000 in savings. And it's very dangerous. And that's why, we, get into debt issues and, using credit cards and things like that. So I'm going to talk a little bit about, what is an adequate emergency fund. As far as retirement as well, we're behind. 22% of Americans have less than $5,000 saved for retirement. So I'm going to touch a little bit about that as well. And then insurance, life insurance, living benefits, long-term care is also important, because after, saving as much money as we can, we don't want it to all go to medical bills when we get older. So we want to separate that. And so I'm going to talk a little bit about that as well. And then right now, the baby boomers are retiring. So if you know anybody who was born between 1946 and 1964, they're called baby boomers. And right now, they're retiring at high numbers, 70,000 a week. Over 280,000 per month are retiring, 78 million of them. And so they also need help how to stretch their money that they have currently, because we're living longer also. How to move it out of investments, 401ks, pension plans, and put it somewhere safer, because when we reach retirement, it's really hard to recover those losses. I'm going to talk a little bit about that, ways to do that. Millennials also, they're going through so much, especially with everything that's happening globally. We want to be able to help guide them, because right now they're getting jobs, they're graduating from school, and we also want to make sure that they're prepared. And then this right here talks about, you know, college, and again, wishing that we would have more of this in school, because most of the students spend high school years learning topics that may have them pass state and nationally mandated exams, but they do not provide much benefit after high school, because it will be better to require students to take financial literacy classes that will help them with the fundamentals that we need. I believe it's a life skill. So again, we gotta learn it and teach our children. And then also there's statistics regarding women. You know, right now women are taking the lead roles also in the home, in the household. So we also want to make sure that we empower women and single moms. People are also becoming more independent and making money part-time. And so we need, you know, to be able to make some sound confident decisions. And then here's another statistics, the last one regarding women, you know, because women have less money in Social Security because we're not, you know, they're not working as much as men, right? We got to take time off to take care of our children. And so we're already behind. And so everybody needs it. So I'm going to start going into our concepts right now. The first concept that I'm going to teach you today, it's called the Rule of 72. So this is a compound interest. Albert Einstein, they say, Albert Einstein, you know, came across this formula. All I know is that it's the 8th wonder of the world. If you know sports, you know that when, you know, there's a football game going on, the football players need to know the rules of the game in order to win the game. Any game that you're involved in, you want to know the rules. Well, this is the rule of money. So if you know this rule, you'll be able to win the money game. Okay, so this is what it means. If you divide the number 72 by the interest that you're earning on your money, it will equal the amount of years it'll take for your savings to double. Okay, so we're going to use some examples just to give you a visual. So when somebody has money and they want to save money, what's the first place you think of that you want to go save? First place that pops in your mind? Like a bank, right? People go to the bank. Yes, I know my grandma said, open up your bank account, and so did my mom. How much is the interest rates that they're paying at the bank? It's not a lot. It's less than 1%. And all the banks are about the same. They're all competitive. They're about the same. It's like 0.01, 0.05%, not even 1%. But we're going to use 1% as an example to help us with this division problem, okay? So 1 goes into 72 times, right? So I'm going to use an example of $10,000. Let's say that somebody has $10,000, they put it in the bank, they get 1%. That means, according to the formula, it's going to take 72 years for the money to double. Okay, so this is how powerful compound interest is. Because 1 goes into 72 times, the money will double in 72 years. So a 29-year-old will not see their money double until they're 101. Hopefully we even make it that long, right? So what about if we get a better percentage, 4%? 4 goes into 72 18 times. That means the money will double every 18 years, which is a lot better. Then what about 6%? 6 goes into 72 12 times, so it'll double every 12 years. And look at what 10% does. 10 goes into 72 every 7.2 years. So now that same 29-year-old is going to see their money double 6 times by the time they're 72 years old. So when I saw this for the first time, I was like blown away, because all my life I worked in banking. I worked in commercial banks. I worked at a central bank. And I didn't know the power of compound interest. So now, you know, we ask ourselves, where are we going to get these percentages, right? If the banks are not offering, where are we going to get them? So that's where we go into learning about finances, learning about the financial industry, and there are ways to do that. Also understanding the 401ks, 403bs, 457, different IRS codes for retirement plans. Also making sure we understand and allocate those funds to be able to generate more interest. And again, you know, it's always best to talk to someone who's licensed to help you with that. Now I'm going to talk about other ways to grow your money. Okay, so here are 3 different ways you can grow your money. The first one is called fixed. That's when you put your money somewhere, and the money, there's going to be very little to no growth. So that somewhere are like bank accounts, right? Like CDs, savings, right? You put in your money in these type of accounts. They're safe, right? They're very safe accounts, but there's very little to no growth. Okay, then we have the variable accounts. The variable accounts are accounts that are in the stock market. Okay, we're talking about, like I mentioned, 401k plans, 403bs for teachers, police officers. They have different IRS codes, 457s. We also have pension plans here, traditional IRAs, retirement accounts. And so here, mutual funds, right? Here, the money goes up when the stock market goes up. The money goes down, you lose money when the stock market drops. So it kind of looks like a heart attack, because it's like you make money, you lose money, you make money, you lose money, right? So there's opportunity for growth, but there's also risk. And then you have the index accounts. Index accounts are based on the performance of the stock market, but they're not in the stock market. So when the stock market goes up, you make money, but when the stock market goes down, you get locked in. You don't make money, but you don't lose money either. So when the stock market goes back up, you make money, it gets locked in. So when it goes down, you don't lose. So it's kind of like a staircase. Oops. It's kind of like a staircase where there's opportunity for growth, but there's no losses. So when I saw this, I was like, okay, I'm very familiar with these two, right? Because I had a 401k at my job. But what about this? I really didn't know about this. So that's where, financial education comes in. I'm like, tell me more. I would love to learn more. Oh, and that's where I was mentioning about baby boomers. So right now, there's a lot of people retiring, and they're trying to take their money out of these variable accounts and put them I would, show them this and say, look, there's places where you can continue to grow your money, but there's no losses. And so this is very, very a good recommendation for people that are getting close to retirement, because that way, if there's a loss, they don't have to wait, so long to recover their losses. And then now we're going to talk about taxes. So taxes, I don't know if you like to pay taxes, but I think we pay too much in taxes. It's okay to pay our fair share. Sometimes we pay way too much. So if we're supposed to be financially independent, and right now we should have at least $1 million for retirement. And so how are we going to reach $1 million if they keep taxing us on everything, right? We get taxed on our income tax. We get taxed when we go shopping on our sales taxes. We get taxed when we buy a home, property tax. We even get taxed when we pass a tollway, right? That's tollway tax. And then also, I'm going to show you on our savings. So we also get taxed on our savings, and how much tax depends on where we put it. So how much tax we pay will depend on where we choose to put the money. So here I'm going to show you. The blue shade represents the amount of taxes we're paying. Okay, so the first one is called Tax Now. So when we put money into these types of accounts, which I'll show you which type of accounts they are. That means you put your money in, and over, at the end of the year, you'll get a letter from, Mr. and Mrs. Client, you made $10, $50, whatever it is you made, you have to report it on your income tax year after year after year. Then we have tax later accounts, which are tax deferred accounts, like the ones I mentioned, 401k plans and pension plans and traditional IRAs. Then we have tax advantage accounts. So the tax later means you don't pay in the beginning, but you pay later. Tax advantages, you pay in the beginning, you grow your money, and you never pay ever again. So now let's talk about where those places are. The first one is the bank accounts, the mutual funds. Right there, you have to pay taxes every single year when you file your taxes. And then the middle one are, like I mentioned, 401k plans, IRAs, annuities, and pension plans. And then the last one is the tax advantage is Roth IRAs and cash accumulation in life insurance policies. Also 529 plans for college for students. If you want to open up a college plan for students, for your children, it would fall into this category as well. But they have to go to college. If they do not go to college, then that money will be taxed and penalized. So you could always gift it to somebody else, use it yourself for education, but it has to be specifically for college. And so I'm going to talk a little bit about these last two right here. Just to give you an analogy. I love analogies and stories. Okay, so imagine that you went to the store, you went shopping and you wanted to buy some seeds. Seeds don't cost a lot of money. Like a little packet of seeds is like 15 cents. Okay, let's say the shop owner says, you know what, great, buy as many seeds as you want. Don't worry about paying taxes. We'll worry about it later. And you're like, okay, great, give me a whole bag. So let's say you buy a bag of seeds. and the bag is $20, okay? You go home and you plant your seeds. What happens over time to those seeds? They grow, right? They grow, and now you have tomatoes, cucumbers, right? You got vegetables. And now the shop owner passes by your house and says, congratulations, great job with those seeds. But remember, when you bought them, you didn't pay taxes. The bag of seeds of $20, you didn't pay taxes, but it's time. Now it's time. It's time to pay taxes, but you're going to pay taxes on the value of the harvest, right? So let's say the value is $1,000 worth of product. That means you're going to pay taxes on the $1,000. And so the middle one here, tax later, that's what it means. It means that you could grow your money, you know, for 10, 20, 30, 40 years of your life, right? And you're going to pay taxes when you pull the money out at retirement. And then this one right here, the tax advantage means, you know what? Tax me now on the seeds. Our paychecks are our seeds. Tax me now, and I'm going to put a portion of that, whatever you want to save, 10%, 20%, into these type of accounts. You grow your money 10, 20, 30, 40 years of your life, and you never pay taxes, ever, because you already paid up front on the seeds, and that's what the blue represents. So when I saw this for the first time, again, I was blown away because I only knew about these two. Because my grandma saved all her retirement money in the CD accounts, and I had all my money in the 401k through my job. So I really didn't understand this. Even though I worked in banks, I never knew what a Roth IRA was. So again, going back to schools and our, you know, even our high school years, we could have learned this in school, so we are better prepared when we go out into, you know, in life and start making these decisions with money. So what I recommend for people is, you know what, it's okay to have all of them. Have a little bit in the bank for emergencies. If you're having some good plans that they're offering you, great, you know, make sure that you design them properly so you can get good percentages. The more money you make, of course, the more taxes you pay, but at least you're making money. Right? So it's okay, especially if there's a match. If some employers offer matches, that's free money. The key is to have someone help you pick the funds within the plans. When I started working at the Federal Reserve, I was 22 years old, and they offered me a 401k plan. They said, benefits department said, here you go, here's the application if you want to sign up for a 401k. And that's it. They never walked me through it, helped me. I had to pick funds. I didn't know about being conservative, aggressive, moderate. I didn't know anything. So I just was guessing. Or I was asking my coworker, you know, what did you put here? And I was copying my coworker like she knew. She didn't know either. So it's like, this is our future. This is our money that we're going to need, and we want it to grow. So we want to make sure that we have high percentages. I've sat down with people that have like 1-2% interest over 25 years at their job. And that you saw what 1% does with the rule of 72. It doesn't grow your money, right? And plus it's in the stock market on top of that. So it's really important to sit down with someone to help you guide you to pick your funds within. And this one, it's really good to be diversified. Have a little bit over here as well, because here is where you're saving on taxes. You could grow $1 million here, tax-free, without having to pay for anything. So I love community outreach. I love helping everybody, because if you go to a wealth advisor or traditional financial advisor, you have to have a minimum for them to even help you. So that's why, you know, we are overlooked in the industry overlooks middle class families, and no one's there to guide us and coach us through these things. But it's so important, and that's why I made it my mission to go out and help as many people as possible. So very powerful. When I first learned about this, my son was 16 years old, and he just had his first job. And I'm like, you need to see one of these workshops. He sat down just like you and saw this. And I'm like, when you start saving, you're going to be over here. If they offer you these plans, we're going to get somebody to help you. Like, I wanted to make sure that he had everything in order, and he does. Now he's 25. He's going to be 25, and he's everything in order. And that's what, now we're going to talk about that. What does it take for us to have our financial house in order? What do we have to do? Okay, here we go. This is kind of like going to the doctor. You go to the doctor and you want to make sure that your goal is the doctor to tell you you're healthy. That's the goal. But before he does that or she does that, they have to run some tests. right? To make sure you're healthy. So I like to consider myself a financial doctor, right? I'm going to say, okay, what is the goal? The goal could be, hey, I want to retire 7 to 10 years earlier, or I want to put my kids through college without having them to get a student loan, or I want to vacation or buy a house. Whatever the goal is, I'm going to be like, okay, let's run some tests and let's see how you're doing if you're on track to fulfill your goals, right? Now, if a doctor comes back and says you have high cholesterol, you're going to have to take these, here's a prescription so you could feel better. There's no obligation that you have to take the medication, right? He's not going to be behind you watching you, but at least you know what you have to do. So same with me, like I'll sit down with somebody, I'll run some tests, which is the ones I'm going to show you now. And then if I see some adjustments that are needed, I'm going to give a recommendation. Now it's up to the person to take the recommendation. They don't have to, but at least they know what they have to do. So that's why I like to say I'm like a financial doctor. So here we go. I'm going to talk about the exams that I do. So the first one is cash flow. We got to find out what's coming in inside the household and then what's going out. What's coming in is with income and what's going out as far as expenses and what's left over, right? What are we doing with what's left over? Are we allocating it towards our goals? Some people are paycheck to paycheck. They're like, there's no money left, right? So we got to do a budget. So sometimes people just need a budget or they need to find out ways to increase their cash flow. So I love talking about ways to increase cash flow because nowadays, one income is not enough. 2 incomes is not enough. They say that we need 5 to 7 sources of income coming in. So I'm like, okay, what talent do you have? Is there something you could do on the side to get some extra money? Even a rental, right? Or, there's so many different ideas. There's tons of articles out there on how to generate more income. And then I love giving people tips, winners on that. The next is an emergency fund. How much is an adequate emergency fund? I didn't even know this, okay? I just found out about this 8 years ago when I started learning this. So an emergency fund is 3 to 6 months worth of your income or expenses set aside in an account readily available, right? So a safety deposit box, a bank account, wherever the money is accessible. So if somebody makes less than $2,000 a month or their expenses are $3,000, multiply that by 3, that's 9,000. So how many people have $9,000 sitting in an emergency fund? Not a lot. Like I mentioned to you in the article, that the majority of families in the U.S. have less than $1,000. So it's very important to multiply it by 3 or up to 6. So imagine if someone's expenses are $3,000 a month times 6 months, that's 18,000. Like who has 18,000 just sitting there somewhere, right? And so that's why if we don't, we go into number 3. So we always use that credit card for an emergency, right? It's so dangerous to do that. And I found people, I was in debt, in my 30s, I had a credit cards. I thought it was normal. I'm like, everybody has them. I would go to the store, I would go shopping and they would say, hey, if you open up a credit card, we'll give you 15% off. And I would be like, okay. And then I would go to the next store and they would tell me the same thing. Hey, if you open up a credit card, we'll give you 10%. So I had like credit cards everywhere, but we have to learn how to manage them. And the rule of thumb is to pay it off at the end of the month. So as soon as the bill comes in the mail, you got to pay off the whole thing. That's when we get into dangers with interest. Remember Rule 72. The Rule of 72 here will work against us if we have high credit card interest rate. How much is the average interest rate? I've seen 15%, I've seen 20%, and I've seen 29.99%. Department stores. Department store credit cards are the worst because they're the ones that charge the most interest. And if you divide that by 72, how many times does it double? Right? So if you go to 20%, right? Let's say that the interest is 20%. 20 goes into 72 3-4 times. That means that the debt is doubling every 3 to 4 years. So that's why the Rule of 72 could work for us if we have good interest, or it could work against us if we have credit card debt. So I help people with debt strategies to get out of debt that are free. Free debt strategies that I've learned over the years and that are, you know, great because that way it'll allow people to save money. The next one is proper protection. Here's where I'm going to ask, okay, do you have life insurance? You know, we have health, we have car insurance, we have homeowners insurance, right? We insure our cell phones, right? But what about our life? You know, what are we doing there? And so sometimes people are like, oh yeah, I have something, you know, I have insurance. I'm like, okay, great. What type do you have? Do you have the new kind or the old kind? Because the new kind nowadays, these companies, they are adding living benefits to the life insurance. So living benefits works like this. If God forbid there's an accident, there's a chronic or critical illness, and you can't work for a certain amount of time, like usually it's 3 months, then you can get money. You can get a check in the mail every month to cover your home bills, your bills at home if you're not working. So living benefits are new. It's a new thing now. All the companies I work with have living benefits. And so I want to make sure that people know about this just in case, especially this year. This year was a year of reflection. Everybody, you know, I've been busier than ever this year, me and my team, because everyone's worried with the pandemic and also with the financials, with the stock markets not being, you know, crazy, and then everything going on in the world. And so life insurance is just something to protect yourself. It's for your family. It's something that you're going to leave for them in case something happens or the day that something happens. So it's a guarantee. We just don't know when it's going to happen, but it's a guarantee. And we don't want to use our hard-earned money to pay for medical bills. And then we want to be able to leave an inheritance and a legacy behind to our loved ones, especially if we have children. Something happens to one of the parents, we want to be able to leave college paid for, and life insurance could help do that. The fifth the exam, I call it, step, is building wealth. So here's where I'm going to say, okay, based on your savings, you know, what interest are you earning right now? Are you getting those double digits? You want to make sure that you're getting those high interest rates to be able to build wealth. And then I'm also going to find out if the money's sitting in tax now, tax later, or tax free. And then I want to make sure that they're diversified, right? So that's where the recommendations come in. And then I'm also going to talk about inflation. Inflation goes up 3%. That means that we need to be making more than 3% on our money. If we're making less than 1% at the bank and inflation is going up 3%, are we keeping up with inflation? No, we're actually behind. And so that's why, you know, in your 60s and when you're ready to retire, most people sometimes can't retire because inflation ate up their money, right? Inflation is going to make you fall behind. And that's why you see a lot of people still working. You see a lot of people still working wherever they can. Who's going to allow them to work in their 60s? Walmart, Sam's Club, McDonald's, and that's where unfortunately you see, you know, retirees, and I'm sure they'd rather be with their grandchildren or on a beach somewhere, right? But it's so important to make sure that, you know, we factor in these things. And then the last one is preserving wealth. After working all our life and, you know, having all these assets, and we want to be able to transfer that directly to our loved ones without lawyers getting involved, without judges having to decide who's getting what, without probate and fees. And so having a will and a testament is so important as well, especially if you have children. You want to make sure that, you know, you have a power of attorney that's going to also make decisions on your health and your financials. And so important to get at least a will, but a testament will be more detailed. So I help guide people with this as well, to be sure that they get the best, because a lot of these lawyers out there, unfortunately, they charge a lot of money for these. I've heard that they've charged up to $1,000, $1,500. It's just crazy. You don't have to pay that amount of money. So I love, you know, sharing resources and letting people know, you know, so they can have more money in their pocket. So this was the last slide. I hope it was helpful, but ask yourself, what are your goals? Are you on track to achieving them? Get yourself a financial checkup. Just like a doctor checkup, we need a financial checkup to make sure that we're on track. Talk to someone who's independent, right? That they're not biased to a company, that they're not married to a company and are gonna push products. There's a lot of salespeople out there. It's more important to first get the education. Then once you have the education, then you can make informed decisions, and you're making confident informed decisions. And what I love to do is I love to get to know families, get to know their children as they're growing up. Just like my son, as he's growing up, I was able to guide him and coach him. If you have children that are, you know, that are working, 16, 18 years old, you know, reach out to me. I will guide them and show them how important it is to start a habit of saving early. I did it with my own son. I was so shocked, but I saw it before my eyes. He started with $10. I'm like, start with $10. And then when he turned, that was 16 years old. Then when he turned 18, I upped it to $50. And he was okay with it. He struggled with 10 because he was not used to it. When someone is not used to savings, it's hard. It's really hard, but you have to keep encouraging them and not giving up, because they say it takes 15. You got to do something like 15 times before it becomes a habit. And literally, when he turned 18, the habit was formed. The habit was formed because once I said 50, he wasn't frustrated anymore. He would get mad at me for $10. Now, when I said 50, he was okay with it. I'm like, wow, he's okay with it because of the habit. That's why. And then when he turned 20, he upped it to 100. And now he's almost $500 a month, and he's 24 years old. I was shopping. I was spending when I was his age. And that's because that's all we know, right? We don't have somebody guiding us and coaching us. So I love what I do. This is, you know, my information. I'm always there to help. But I do want to open up, you know, I don't know how much time we have, but if we have, you know, time for questions, we could do that as well.
We definitely have some time. So if anybody has any questions, please feel free to ask.
I'd be happy to.
I have a question about the tax for the 401k. So right now, where I work, they do deduct for the 401k. You mean by the time I get it back, I have to pay taxes for the amount already saved?
Yes. So nowadays, some employers are offering a Roth 401k. Not everyone. I want to say maybe 10% of the people that I've been sitting down with have a Roth 401k, but the majority are traditional 401ks. And you definitely, if you're looking at your statement, that's not your money. You're looking at you have to pay taxes.
Wow. You know what's the percentage of taxes they deduct from it?
It depends on your tax bracket. If you are like, you know, some people leave jobs, they go to another job and then you could roll it over. But if you cash it in, it's about 30%, plus you have to pay a 10% penalty if you use it, because you have to be 59.5. So it's meant for retirement. And so in the future, it could be 20%. It depends on your tax bracket.
Well, they're taking it out of my check. Like I could choose not to and just keep it.
Yes. Find out if they're giving you a match. If they're giving you dollar for dollar, that's a good, you know, it's free money. So if you save $1, they give you $1. That's,
I think so, yes. They're doing it for a match.
Yeah, I encourage people to take that on because it's free money. But you have to know how to pick your funds within the plan so you can have a high rate of return in the end. Some of them are okay. The 401k plans, if designed properly, are good. But you need to, you know, and I don't charge for that. I don't charge people for a consultation, for analysis, for reading a statement, none of that. Because I believe that if you do the right thing for people, money will come from somewhere. Somebody's going to need help. Be able to help them, and you know, and the financial service industries, they pay very well anyway, so it's like it doesn't matter. I was able to leave that career working 40 hours a week. Now I work 40 hours a month and I get paid what I was getting paid over there. And that's another thing. If you know anyone who would like to learn this industry, I'm also a trainer and I train financial professionals to learn this industry.
Yes. Thank you.
Yeah. Yeah, give me a call and I can help you allocate, make sure that you are properly funding.
Thank you so much.
And you,
All right, if there's no more questions, if you don't mind just making me the host before you go, and then I will, I'm also recording this meeting, so if anybody wants to go back and review, or if you need any of the information, you can go ahead and watch the recording as well. Thanks everybody for joining us today. I hope everybody has a great weekend, and I hope everybody stays safe and healthy.
Thank you for the
Thank you
invitation.
so much.
Thank
Thank you.
Bye.
Bye, everyone. Thank you.
You're
Bye.
welcome. Bye.